Let's break down trading into its simplest form. Trading is just buying and selling things, whether it's stocks, crypto, or even a rare Pokemon card. The goal? Buy low, sell high, and make a profit. Every time you buy groceries, you're trading your money for goods. Financial markets work the same way, just on a bigger scale. Some people invest for the long term, others look for quick wins. Both are valid strategies. The two main ways to trade in financial markets are spot trading and futures trading. Knowing the difference is crucial before risking your money. Think of it as learning the rules before playing the game. In this video, we'll break down spot and futures trading with simple examples so you can decide which fits your goals. Let's get started. Spot trading is the most straightforward way to trade. It's the simplest form of buying and selling assets in the financial markets. Imagine you're at a farmer's market browsing the fresh produce. You hand over $1, get an apple, done deal, a direct exchange of value. That's spot trading. You buy an asset at the current price and own it immediately. There's no delay, no waiting period. Whether it's a stock, representing a piece of a company, gold, a precious metal often used as a store of value, or crypto, a digital or virtual currency secured by cryptography, you pay now and it's yours. The transaction is settled instantly. If you buy a share of Tesla, the electric car company, it's in your account right away. You can see it reflected in your portfolio almost instantly. You own it, and its value moves with the market. You're directly exposed to the price fluctuations. No contracts, no waiting, just direct ownership. You have immediate control over your asset. This simplicity makes spot trading the go-to for most beginners and long-term investors. It's easy to understand and execute. It's like shopping. Pick what you want, pay, and walk out with it. The asset is yours to hold or sell as you wish. If your stock pays dividends, you get them because you're the owner. You're entitled to the benefits of ownership. Spot trading is all about owning the asset right now. It's about immediate access and control. It's the foundation of most investing. A fundamental concept for anyone entering the world of finance. Simple, direct, and tangible. That's the essence of spot trading. Now let's talk about futures trading. Think of it like pre-ordering concert tickets for a show months away. You lock in today's price but get the ticket later. Futures trading is about contracts. Agreements to buy or sell an asset at a set price on a future date. You're not buying the asset now, you're betting on what its price will be. Most futures traders never touch the actual asset. They just trade the contracts. The real draw? Leverage. You can control a big position with a small deposit, amplifying both gains and losses. If the price moves your way, you profit. If not, losses can pile up fast. Futures are all about speculation and risk. It's a high-reward, high-risk game. Let's compare spot and futures trading side by side to really understand the nuances. We'll break down the key differences from ownership to settlement, and even the risks involved. This comparison will give you a clearer picture of which trading style might be a better fit for your investment goals. Spot trading means you own the asset right away. Simple and direct. You're essentially buying the actual commodity or currency, taking immediate possession. Think of it like buying gold coins. You get the gold immediately. Futures trading, on the other hand, means you own a contract, not the asset itself. You're buying an agreement to buy or sell the asset at a predetermined price and date in the future. Spot trades settle immediately. The transaction is finalized almost instantly. Futures settle later, at a set date. This date, known as the settlement date, is when the actual exchange of the asset or its cash equivalent takes place. Spot trading usually requires full payment up front. You need to have the entire amount of the asset's value available to complete the purchase. Futures use leverage, so you only need a fraction of the total value. This fraction is known as the margin, and it allows you to control a larger position with less capital. Leverage can boost profits, but also magnifies losses. While it can increase your potential gains, it also significantly increases your risk exposure. Spot trading is often for long-term investors who want to own and hold the underlying asset, believing in its long-term value. Futures started as a way for businesses to hedge risk, particularly in industries like agriculture, where producers need to protect themselves from price fluctuations. But now futures also attract speculators chasing quick gains by betting on short-term price movements. The key difference: spot is about ownership. You are directly buying and holding the asset. Futures are about betting on price changes, speculating on whether the price will go up or down. Spot is simple and steady, a straightforward transaction with immediate ownership. Futures are complex and risky, involving contracts, leverage, and the potential for significant gains or losses. Know which fits your style before you jump in. Understanding these differences is crucial for making informed investment decisions. All trading involves risk. It's an inherent part of the financial markets, and understanding the nature of that risk is absolutely crucial before you even consider putting your money on the line. But the type of risk you're exposed to can vary dramatically depending on the trading method you choose. It's not a one-size-fits-all situation. With spot trading, your primary risk revolves around the potential for the asset you're trading to lose value. This is a fundamental risk in any market. If the price drops, you have the option to hold on to your investment and hope for a future recovery. This strategy requires patience and a belief in the long-term potential of the asset. Your potential loss is limited to the amount you initially invested. You won't lose more than what you put in, and as the asset's value increases, your gains grow proportionally. This creates a direct relationship between the asset's performance and your profit. The absence of leverage in spot trading means your returns are generally more steady and predictable, offering a sense of stability. Futures trading, on the other hand, is a completely different beast altogether. It presents a unique set of challenges and opportunities. Leverage is a key component of futures trading, and it means that even small price movements can potentially double your initial investment. But be warned, leverage is a double-edged sword. Those same small price moves can also wipe out your entire investment just as quickly. If the market moves against your position, it's possible to lose even more money than you initially invested. This is a critical distinction from spot trading. Margin calls can occur, forcing you to deposit additional funds into your account to cover potential losses. Or, in some cases, your position may be automatically closed at a loss to prevent further financial damage. Futures trading offers the potential for substantial rewards, but it also comes with significant risks that can materialize very quickly. Spot trading generally provides a safer and more manageable trading experience, especially for beginners. Futures trading is better suited for those who possess a higher risk tolerance and can effectively handle rapid market swings and the high stakes involved. Before you decide which path to take, it's essential to understand your own risk tolerance and investment goals. So, which trading style fits you? Spot trading is best for most people, especially beginners and long-term investors. It's about owning assets and letting them grow. It's simple, less risky, and doesn't require constant attention. Futures trading is for experienced, active traders who thrive on risk and fast moves. It demands skill, discipline, and a strong stomach for volatility. Think of spot trading as planting a tree. Slow, steady growth. Futures trading is like betting on a horse race. Quick, risky, and intense. For most, start with spot trading and learn the basics before considering futures.